quick audit on the post-holiday reopening vector. Let's get right to it. While Wall Street was dark, the smart money was pulsating through the Asian supply chain, and the conclusion is crystal clear. A massive capital rotation just happened, and it's signaling weakness for U.S. tech at the open.
This single frame tells you everything you need to know. It's a high-velocity flow switch. Capital is being yanked out of tech and rerouted straight into defense. The key thing to understand is this isn't a forecast. The money has already moved. This is a report of what's done, not a guess at what's to come.
Okay, let's dig into the core data. During that 48-hour U.S. market blackout, foreign capital initiated a huge liquidation out of the Korean market. This number right here, negative 1.5 trillion KRW. That's our focal point. This isn't just market chatter. It's a powerful signal of aggressive, calculated profit-taking.
So let's break down the hard numbers that prove this rotation happened. And even more important, let's pinpoint the exact trigger that kicked this whole thing off. Now, on the surface, the main KSPI index looks, well, boring. Down just a little bit. And this is noise, right? It's designed to make you look away. If this headline number is all you see, you are completely missing the real story happening just beneath the surface.
And this is where we find the proof. Check out those crimson red bars, a minus 3.80 billion KRW sell-off from foreign funds, with institutions dumping another minus 5.51 billion. This is the smart money. They are liquidating their tech exposure before the U.S. market even has a chance to open and react. So what lit the fuse? What was the trigger? It was the U.S. 10-year Treasury yield. The second it popped above 4.27%, it was like a switch flipped. It forced a global repricing of tech valuations. And Asia? Well, Asia moved first to price it in. So you may be asking, okay, but why does a sell-off in Korea really matter for the U.S. Open? It all comes down to a slick mechanism called proxy hedging. Let's break down exactly how the big players use this. First off, you got to understand that these huge global funds can't afford to just sit on their hands. When they need to hedge massive risk, they need markets with deep liquidity so they can move their portfolios fast. Time zones don't matter. The capital just finds the most efficient venue.
And this is exactly why Korea is that perfect venue. Its giant tech sector, with names like Samsung, acts as a direct, highly liquid stand-in for NASDAQ sentiment. It's simply the best way to place a bet on U.S. tech before the U.S. even wakes up.
So let's connect the dots. That negative 1.5 trillion KRW outflow, it wasn't really about Korea, no. It was global funds placing a tactical short on the NASDAQ 100 through its proxy. By selling the Korean ETF EWY, they are effectively shorting the big U.S. tech ETF QQQ hours before the opening bell. The bets are already on the table.
Now let's move on to the canary signal. This is where we look past the obvious and find what's really going on, where the alpha is. This is how we see that clear sector decoupling. So while the main index looked dead asleep, the hidden signal was this explosive split between key supply chain nodes. The giants were quiet, sure, but the upstream alpha, those critical suppliers, they were screaming, telling us exactly which way the capital was flowing. And this slide right here paints the perfect picture. On the left, you've got weakness in a strategic tech partner like SK Hynix, a major player in AI memory. And on the right, clear signal activation in a defense node, Hanwha Aerospace. This isn't random. It's a direct reallocation of capital, plain and simple. The rotation couldn't be more obvious. Capital fled the semiconductor sector, those are laggards, and ran for cover in the leaders, defense and energy. This is a classic risk-off defensive pivot. It's pricing in geopolitical risk over the promise of future tech earnings. And the strength in the energy sector, which you can see here with Doosan's heavy industry tech, is a really crucial piece of this whole defensive pivot. It's not just about defense, you see. It's a broader move into hard assets and energy security.
Okay, so that's the analysis. Now for the important part. How do we translate all this into a solid, actionable plan for the U.S. session? This is your tactical brief.
Here it is, a simple 3-step execution guide based on what we just saw. 1, watch the U.S. 10-year yield like a hawk right at the open. 2, if it breaks above that 4.3% threshold, you should be prioritizing your defensive positions. And 3, you absolutely have to know your key invalidation level.
This watch list gives you the direct U.S. trades that correlate to the Asian signals we just saw, and pay close attention to that correlation coefficient, the rho. The link between SK Hynix and Nvidia is sitting at 0.82.
That is an incredibly strong leading indicator. On the flip side, Hanwha's signal activation has a row of 0.75 with defense names like RTX and LMT.
Now, this is absolutely critical. Every single vector analysis needs an invalidation point. This is your I'm wrong level. It's the number that, if breached, tells you the thesis is busted and it's time to reevaluate right then and there.
And for this particular thesis, that key level is 25,450 on the NASDAQ futures. If we get a decisive break below this support, that confirms the bearish signal from Asia is taking hold. But if that level holds strong, it could invalidate our entire short-term bearish view.
So the takeaway is clear. The Asian vector is confirmed. The signal has been sent directly from the supply chain. The money is already in motion. So the only real question left is your portfolio braced for the impact?